Alright, greetings friends and welcome to the Financial Game Special Edition. As always, Jose Miguel Garpi, Ferdinand Roaño bringing you the latest market information. In this episode, as we always do, we'll follow the routine for the first episode. Economics, macroeconomics, traditional markets, and the status of the different portfolios. Greetings, Jose Miguel.
Greetings to all our audience once again. Thank you for joining us and tuning in. Now, in English, in Spanish, we have variations by popular demand. So something that started in Spanish, as I was asked last time, is now also being streamed in English. Here, the audience in the United States wants to listen to us. So I'm very happy. Felix, it was interesting what happened. Now, the month of October has closed another chapter, but it closed very well.
To have a seasonality that is typically negative. Thank you. The market is very strong, and that's what we're going to talk about now for a bit, because this market really reminds me of 1998, 1999, the way it's reacting. And that has some implications that we're going to discuss a bit. Unlike people who think this is a bubble that's going to burst or whatever, typically the late runs in markets like these are the most powerful. So you don't want to miss out. So I'll leave your analysis specifically to you. That's really important.
Ferdinand, as of last Friday's close, we had the Nasdaq up 16.93% year to date, the S&P 500 at 15.18%, and the stress-free equities portfolio at 27.37%. We've talked about this in the past, generating very good alpha and maintaining that alpha so far this year. As you mentioned, with September historically being a slightly more volatile market, even so, we've seen.
And that alpha has also been greatly helped by the discipline of the rebalancing strategy.
That's right. That's very important. It's quite active, the management we use in that portfolio. So within the same portfolio, Ferdinand, during September, we saw a small rotation. That's important. The big winners of the year, a bit of profit taking is normal, especially to close out a quarter. It's something that happens, right? If you have a portfolio with different companies in it and you have a company that really performed excellently, it's normal to see a bit of what they call profit taking or locking in some of those gains. Larry Williams mentioned this in his most recent report for those who follow him. He's one of the most important and consistent market forecasters in history in terms of forecasting, which is something that isn't easy, nor is it certain or guaranteed either. But he does his analysis and has his indicators, and he talked a bit about that, how he believes that in the short term we might see some profit taking in those companies and in the market that have performed exceptionally well. However, he does see a good opportunity for the beginning of 2026, which goes hand in hand with what you mentioned, right? It's like when we've had such a strong market, we might see, let's elaborate on that, we might see a somewhat stronger run. If we extend the time frame a bit more to the intermediate term, he does see some degree of increasing volatility in 2026. It's worth mentioning and remembering. At the beginning of the year, Larry Williams, in his analysis for 2025, had predicted that it was going to be a strong year for the markets. So on that front, he was correct.
And that there was going to be a strong pullback. Mainly, and he timed it pretty much perfectly between March and April.
That was the ideal entry point. So nevertheless, well,
Elian, what he's really looking at, just to clarify, is not that there's going to be a catastrophe, it's simply a small correction due to valuations and several of his methods.
Anyone who is forecasting or anticipating some kind of volatility in the markets, some kind of pullback, is usually looking at it right now from a valuation perspective. Historically, if we look at the S&P 500, the historical forward P/E is around 17 or 18%. Right now, the historical forward P/E of the S&P 500 is at 24 or 25. In that regard, strictly speaking, we're looking at the forward PE, and there are several analysts saying it's overvalued. Typically, this should be reflected in some way, such as a pullback or profit taking in this case. However, Ferdinand, the same companies keep raising their forward outlook every time they report earnings. This often should be carefully adjusted at the level of earnings expectations going forward into the future. So it's that delicate balance we're constantly looking at and evaluating. Now, we can't just cover the entire sky with our hand, as we often say, meaning we've just come off a truly huge and significant run so far this year, a truly remarkable and substantial run in the year 2024. So it's entirely understandable that Historically speaking, there are many people who genuinely think, well, the market rally is quite tired, it has run completely out of steam, and there absolutely has to be some kind of significant volatility, maybe even a negative period in the financial markets. Why might many intelligent people be genuinely mistaken in thinking that particular way?
Well, what has typically and historically happened in financial markets like this is that when you have a significant bull run, like the one we are currently experiencing now, the market feels extremely comfortable and quite secure because it has the crucial issue of strong earnings, productivity, and a Federal Reserve that now explicitly comes into the economic picture as a significant and supportive ally of the market because it is actively moving toward implementing lower interest rates, a more accommodative and expansionary monetary policy, which is ultimately more favorable to the overall market conditions. Well, theoretically speaking, this particular situation reminds me a great deal of the year 1999, when I distinctly remember that back then, this was in fact 26 years ago, there was, and I have indeed mentioned this in several of my seminars, the rather intriguing concept of the Internet Vault. Of course, there are significant differences within this particular market, and I want to clarify that artificial intelligence, or AI, truly has real, tangible, and projected earnings. Correct. In the case of many of these stocks back then, they were just pro formas, just projections of what was supposed to happen in the market, on the internet, to a
certainly more speculative degree, or not much more speculative, versus having real earnings.
Much more speculative. A
new
industry. But history tells us, if we go back to 29, which was the prelude to the Great Depression, the stock run that happened was almost a 45% increase. If I look at the NASDAQ and we look at a chart, the NASDAQ was at 2,600 around this time in October. It reached almost 5,000 by March of the year 2000. I repeat, the NASDAQ was at 2,600 around this time in 1999 if you look at a chart. It went up to over 4,400, 4,500 by March 20th, which was the absolute peak of the market in the year 2000. So, the last rallies at the end of the bull market phase are the most violent, and people tend to forget because skepticism starts to set in. And that's why you need to have the discipline to rebalance. For example, several clients, some of them come to me more often because they know I went through those markets 26 years ago, as well as other crashes. I always said I wasn't going to make the same mistake again. The mistake I made in the year 2000, because I'm quite humble about this, I acknowledge the good calls, but I also recognize the ones I really didn't get right. It took me a while to realize that the market had turned and changed direction, and I made the change in June or July of 2000, rebalancing the portfolios. A little late. I made the change, but a little late. This time, with the benefit of experience, what I recommend is to keep rebalancing now in December. We had a rebalance now on September 30th. Maintain that policy, but stay in the market because these late bull runs are powerful. They are very powerful, and you don't want to miss out. If you need to have an indicator that gives you a trigger, that is an exit signal. It could be a moving average, it could be some momentum indicator, but those are the things we talked about yesterday.
And you obviously mentioned, I think the cherry on top at this moment is the campaign. That the Federal Reserve has started cutting rates? Should there be some kind of additional push? Why? We already had the first 0.25% rate cut at the last Fed meeting. Now, on October 29th, there's another decision. Currently, Ferdinand, 94% favor the fact that rates will be cut again in October, another 0.25% according to the Fed funds. Futures this morning confirmed it.
Do you remember that in the English webinar we did, in one of the last ones, there were several portfolio managers, just to let the audience know. We were the only ones in real estate, and I think I was the only one who said that at least 50 basis points would be cut between now and December. Everyone else said, no, it's not necessary to cut rates.
Well, we've already cut by 0.25. There's a 94% probability of another 0.25 in October, and believe it or not, right now there's an 83% chance of another 0.25 in December. This means that after the debate we had and the point where we were practically all year, it would be 75 basis points. One of the best in one of the reels.
We're doing the debate that Eddie suggested, to have a debate. Why should we lower rates and why shouldn't we?
So basically, in Arroyo de la Hinchuela, we're seeing that from now until the end of the year, it's already October. In the next 3 months, we'll be half a point lower than where we are right now.
Well, that's going to add fuel. It's going to add gasoline to the fire, okay? And, well, there's one thing I can guarantee. They say there are few certainties in life. I'd say this is about as close to a sure thing as you can get. At some point, the markets are going to run. The problem here is that you just don't know when.
The importance of staying alert, the importance of, like I always mention, diversifying. And for example, we can go a bit deeper in the next episode on how defined outcome portfolios are starting to appear, positions that give you participation in the upside and downside, not just downside protection. Now, positions are also starting to come into play where a negative market can generate some kind of return. That's what we call an absolute return in some of the classes. So we'll stay in touch, bringing information to the audience. And in the next episode, we can go a bit deeper and see where we stand.
Well, that's all the time we have for today. See you in the next episode of the Financial Game Special Edition. Until next time.